Zoom recording. Okay, so I'm going to, I'll record today's lecture again, and I will put it here. It'll be chapter 13 lecture for March 25th. All right, so that's admin notes. I'm trying to think if there's anything else that's urgent. Any concerns? Stop share. Any concerns around that? All right. I will talk to you. I'm going to plan to talk to you guys at the end of econ. I'll take a couple of minutes to talk to you about where we're at with the internship. We did meet yesterday and discuss the internship. So I've got some information for you. It's not as much clarity as I'd hoped for, but we are working towards an agreement between the faculty on that, but I will spend some time on that at the end of econ. All right. So that said, let's go ahead and get started with today's lecture. So I'm going to switch my video for a second. I'm going to be hopping between the document camera and the an Excel today, but remember, one of the key things we're working on for chapter 13 is calculating our weighted average cost of capital, or corporate cost of capital, CCC. Or I forget. I think the book uses CCC. I grew up using WACC, or weighted average cost of capital. They are the same thing, just a different name for the same thing. So weighted average cost of capital, remember the formula is the weight of the debt times the required rate of return on the debt, right? Times 1 minus the tax rate, if this is for profit, plus the weight of the equity, times the required rate of return on the equity, right? And then this is true for profit. You drop this term, the 1 minus T, if you're doing a not-for-profit entity. Okay, so I wanted to make that point. I wanted to talk a little bit about this in particular and that rationale for why do we drop that 1 minus T? Well, if you remember from exam 1, the material we were doing for exam 1, and I think it's chapter 11, we said that like if you are Wentworth Douglas, you can offer a lower interest rate, right? You can lower a lower coupon rate on your bonds, and hence a lower interest and a lower effective yield, or yield to maturity, than for-profit companies can. And the reason is Wentworth Douglas is a not-for-profit hospital and is treated as a municipal entity, which means that if people own your bonds, if you are a municipal entity, people own your bonds. When you pay them interest, they don't have to pay federal taxes on that interest. And as a result, they get to keep more, they get to keep all of their interest. But if you are, so let's say you are HCA, right, which is a for-profit entity, and you have, I'm just going to use easy numbers. These are not real numbers, right? But you have a 10% coupon on your bonds. You then wind up paying your shareholders. Let's say your bonds have a par of 1,000. Then you wind up paying your shareholders 0.1 times 1,000 per year, right? Or $100 per year. Now you would pay that most likely in 2 semi-annual payments of $50 and $50. But at the end of the year, your bondholders would receive $100. And let's say they are in the 30% tax bracket, right? They're going to have to pay 100 times 0.3, or $30 in taxes. So at the end of the year, what they have is 100 minus 30, or $70. On the other hand, if you're Wentworth Douglas, right, WDH, Wentworth Douglas, you know that investors are considering either buying your bonds or buying HCA bonds. If they buy your bonds, they know they don't have to pay those taxes. So what you really want is to make sure that you want your investors to go away with at least as much money in their pockets after taxes as possible. But since they don't have to pay taxes on your bonds, you can pay them less. You could pay them 70. So we gave you that formula, AT equals BT times 1 minus T, right? So if you want to find the equivalency between Wentworth Douglas and HCA, what you're going to put in for the BT is the amount of, the interest rate, the coupon rate that HCA pays, which is going to be 10%, multiply it by 1 minus the tax rate, which we said was 30% or 0.3, and you get 10 times 1 minus 0.3 or 0.7. 0.7 times 10 is 7, right? So Wentworth Douglas has to offer, in order to be equivalent to HCA, they only have to offer a 7% coupon, whereas HCA has to offer a 10% coupon. However, if HCA is a for-profit entity, which it is, and it pays taxes, what we worked on last time should give you some idea. Let me shift my screen now. So we're looking at the spreadsheet that we used in class last time. Oh, I meant to delete. Sorry, let me delete that. That's my punchline. Yeah. Right. So last time we looked at one organization facing the same operational environment with different financial structures. So we had this company, this notional company, right, that had 200,000 in assets, and it financed those assets in different ways. Option A, they financed it with 100% equity. Option B was 50% equity and 50% debt. And option C, they went with 80% debt and 20% equity, right? And so we had 3 different outcomes as a result. Now, what I want to show you is that HCA, if this was HCA, let's say, HCA would effectively wind up paying the same interest rate on their bonds after we calculate the effect of taxes. So how do we do that? Well, what we're going to look at is I'm going to bring down, and you can go do this along with me if you'd like. I'll upload this after class as well. So let's put in our interest paid, right? And so we'll just grab that off the line here. I'm just going to do equals that, right? And so I'm going to copy that across. And now I have just quickly got the interest paid under each of these conditions. So A is 100% equity, so they pay no interest. B was 100,000 in equity and 100,000 in debt, so they're paying 10% on 100,000 in debt, so $10. B had $160,000 in debt, so they're paying 10% of 160,000, which was 16. Now, as a result of having to make interest payments, because interest is an expense and therefore reduces our taxable income, we have a reduction in taxes as a result of having corporate debt. And so the reduction in taxes here, there is no reduction in taxes because they, in option A, they don't pay any interest, so it's 0. Option B, what we're really doing is comparing the amount of taxes paid in B versus A, because in B we are paying taxes, and so we want to see how much less is our tax burden as a result of having the debt. So we can say we would have been 15, but we actually paid 12. So we saved 3,000 in taxes. And then over here, we have, we pay $16,000 in interest, which reduces our taxes from 15,000 to 10.2 thousand, right, or 4.8. Now, our effective interest payment then is actually 0 in this case, right? And then because we paid our interest, we paid 10,000 in interest, but we reduced our taxes by 3,000. We actually paid effectively 7,000. And then here we paid 16,000. But effectively we reduced that by the fact that we paid 4.8. We reduced our taxes by 4,800. The principal that we want to say, all right, we paid interest on some amount of principal. So how much principal did we have? In this case, we didn't borrow any. In this case, we borrowed 100. And in this case, we borrowed 160. So our effective interest rate is, in this case, it's 0, but in this case it is 7. It is going to be the effective interest payment divided by the principal, or 7. And in this case, it is the effective interest rate divided by the principal, or, oh, hey, 7. How about that? And we can make those percentages to look pretty, right? So this is a demonstration of what I just did on the document camera a second ago, right? Where I said, let me switch back. Right. So back at the document camera here, said the effective cost of debt for a for-profit company is the weight of the debt times the required rate of return on the debt. Well, the required rate of return on the debt in the example we were working, say for HCA, is 10%, but their tax rate, we said in the example, was 30%, and so they wind up with a 7% effective return, which would set them equal to, say, a not-for-profit in the same market would be paying 7%. The key difference here is that the for-profit entity pays notionally, really pays 10% interest on its bonds. But because they wind up saving 30% of that 10% in taxes, their effective tax rate is actually 7%. Not-for-profits don't pay any taxes, but they wind up getting a lower interest rate up front. So their coupon is 7%. They don't get any benefit from reducing their taxes because they don't pay taxes. So they wind up paying 7%. So at the end of the day, whether you are for-profit or not-for-profit, your required rate of return on your debt is going to wind up being the same if you have the same, all the things that we talked about in, I think, chapter 11, in terms of what creates risk, right? The cost of debt, right? The interest rate comes from inflation risk. It comes from default risk, mostly default risk. It comes from price risk, right? How long is your maturity? It comes from liquidity risk. How well known is your entity? Things like that. But whether you are for profit or not for profit doesn't matter. If Wentworth Douglas was a not-for-profit entity that had the same level of risk and the same and all the other same risk factors as HCA, after all was said and done, after HCA paid its taxes, they would wind up having the same cost of debt. Okay, so that's kind of, I know that's kind of a long way of trying to explain why do we do this. Essentially, for-profits get the benefit after taxes, not-for-profits get the benefits before taxes. All right, so when we talk about the effective cost of debt, we have to consider taxes. And the effective cost of debt, again, for a not-for-profit, for a for-profit, so effective cost of debt for profit is going to be RD times 1 minus T. Not for profit is going to just be RD. Now, where does RD come from? Well, it comes from the debt contract. What percent are you paying? It's the coupon rate, right, that you're required to pay, right? So the yield that you're required to pay by contract. The for-profit is going to wind up being higher up front, but it'll be reduced by the amount of taxes that they pay. So debt is actually pretty straightforward. You just find out what's the debt contract say. So when you're trying to find out what's the cost of debt, it's pretty straightforward. You just look at the cost of debt for the entity. So what we're interested in trying to figure out that weighted average cost of capital, right? Where we're talking about the weight of the debt times the required rate of return on the debt times 1 minus the tax plus the weight of the equity times the required rate of return on the equity. So we've talked about this. Now we've got to talk about this. This is pretty straightforward. Like I said, you just have to remember to say, okay, what is the APR that they're paying or the coupon rate that they're paying? And you can say, okay, that's the required rate of return. And then you have to ask, are they for profit or not for profit? If they're for profit, then you're going to modify it by the taxes. If they're not for profit, then they would have already issued their debt at a lower rate anyway. So now we're going to, let me pause and say, does that kind of make sense? And you can give me a yes or a smiley face or anything, or throw me a question mark saying, hey, do it again. Or I will probably make a short video demonstrating this. Thank you. Okay, everybody's chiming in. I'll probably make a short video explaining this again so you can go over it again in case you want to review it again. I did do that for econ for our discussion of the cost curves and the shutdown conditions. So I'll mention that later. So I'll just kind of take, I guess what I'll kind of do is if I hit a point where I think it's a complicated idea, I may go ahead and record like a separate video. Hopefully that's pretty okay. You can always, you do have the advantage of being able to go back and look at the video. Okay, just to clarify for Ariana, is it a for-profit that gets benefit after taxes? Yes, because a not-for-profit doesn't pay taxes, so there's no meaningful before and after taxes for a not-for-profit because they don't pay any taxes. So this applies to just the for-profit. All right, good. My dog just came in and laid down on all my notes. All right. Okay, so we're gonna talk about where does this RRE come from, right? And that's the required rate of return on equity. Now, you remember in the last chapter, last two chapters, we've looked at a couple of different models, right? The first model that we looked at was CAPM, capital asset pricing model, and we said the required rate of return on equity, and I'm going back and forth between using capital E and lowercase c, don't worry about it, is going to be equal to the risk-free rate plus the required rate of return on the market minus the risk-free rate times the beta of the equity. So if we were talking about what's the required rate of return for Wentworth Douglas, you'd have to come up with an appropriate risk-free rate, which we've been saying we've been using the 10-year Treasury bond as kind of our proxy, right? The required rate of return on the market, RRM, the required return on the market, we've been using some sort of broad stock market index. The two that I've talked about a lot in class have been the S&P 500, which is the 500 largest. The stock prices of, it's based on the stock prices of the 500 largest firms in the United States. The other one that I've used is the Wilshire 5000, which is based on the stock prices of all the 5,000 stocks that are generally publicly traded in the United States. The the S&P 500 is one component of the Wilshire 5000. It's the 500 biggest that are included in the 5,000, but the Wilshire 5000 also includes, the Russell 2000, which is the 2,000 smallest stocks, and then there are some kind of mid-cap, meaning or mid-sized indexes as well that you can kind of play. If you're an investor, you can kind of play the two against each other. The Wilshire 5000, if you've been paying attention to the stock market at all over the last 2 weeks, the Wilshire 5000 has taken a hell of a beating, much more so than, even more so than the S&P 500, which I think is down about 30% in the last 2 weeks. The Russell 2000 is down more like 40%. Most of my retirement is in the Wilshire most of my retirement is in the Russell 2000. So I've lost a small house worth of investment value over the last couple of weeks, but at least I don't have coronavirus, so that's a good thing. And it'll come back. The S&P 500 made something like an 11% increase yesterday on the stock market. So, the market comes and goes, and you just have to have the patience to wait it out. So you guys are young. I've been through at least 5 major stock market crashes in my investing career over the last 30-ish years. So, I'm not stressing about it. I'm hoping I've got a fair amount of cash set aside that I think I'm going to start pumping into the market once I feel like we've hit a bottom. But anyway, so option 1 for calculating the required rate of return is to use CAPM. So you don't want to forget about CAPM, okay? Because we'll need that when you do your problems for chapter 13. Some of the problems are going to assume that you use CAPM to calculate the required rate of return on equity. Another model that we worked on was from chapter 12. Was the dividend valuation model, constant growth dividend valuation model, which said the required rate of return on equity is equal to D0 times 1 plus EG over P0 plus EG, right? Which is also the equivalent of the forward dividend, the next dividend, right, divided by P0 plus EG. So let me show you a quick example what I'm talking about. Um, when I said the forward dividend, oop, nope, where'd my, there we go. So HCA, right? If you can see it, I don't know if you can see it well, but looking on Yahoo Finance at HCA, which if you remember a couple of weeks ago when we looked at HCA, it was trading at 140 and is now trading at 94.5. So I think, um, yeah, not that long ago, like a couple of weeks ago, we were looking at it. Oh, it was at 120 maybe. 135. I remember showing to you guys and it being like 130 something. So as you can see, it was 136 on March 4th. As of March 18th, which was, last week, it had fallen to 60 and now it's all the way back up to 94. So that's how the market works, right? If you're going to be a stock investor, you've got to be able to ride that kind of fall down, right? Says when it lost more than 50% of its value in the course of about 12 days. And now it's back up to 94. So, I mean, I'm guessing in 6 months, HCA will be back up to 130. I wouldn't be surprised. So, if you had a bunch of money laying around, you could buy some HCA stock, and you might make a nice like 30% return in a couple of months. Oh, or HCA could go bankrupt for another reason, and you lose all your money. So don't listen to my tax advice or stock market picking advice. If I was that good at it, I wouldn't be sitting here. I'd be on Wall Street making a ton of money. So we have this, but we have this model. So going down here, the key thing I wanted to point you to was their forward dividend rate is 1.72. The forward dividend rate is the D1, right? So D0 is whatever the last dividend was. Their next expected dividend is 1.72. Hopefully you can see that. I realize it's small, but you could, if you would like, you can just jump on Yahoo Finance and look up HCA and you can see it yourself. So let me stop the share. So if we know, so that would be the D1, right? The forward dividend. D1 is called the forward dividend. So in the case of HCA, that would be 1.72, right? Then you would have HCA's P0 is today's stock price. That's 95.16. And then we'd have some expected growth rate at which we expect the firm to grow. So 1.72 divided by 95.16 is 0.018 plus EG. So right now that's 1.8%, and then we have some EG that we don't know that we would have to estimate in order to get the required rate of return on HCA's equity. Now, a quick and dirty way to estimate what the market thinks, and I won't hold you accountable for this, but it's just kind of I'll share this with you as a general knowledge point. Are you guys? I hope you guys are seeing. Let me see. Share. Okay, so you should be seeing the HCA stock price. So let me see. I think. No. There we go. So if you see this thing called the PE ratio, this is the price earnings ratio. So this is the price divided by the earnings per share. And so in this case, it's the previous day's price. So it's the trailing or lagging PE ratio. So PE divided by earnings. So price divided by earnings of 8.74. Investors will use the PE ratio as a proxy for what the required rate of return for a stock is going to be. So in this case, if you were going to use that, and not everybody uses it, and not everybody agrees that it's the right number, but this is basically, investors generally agree that if a stock has, say, an 8.74%, a price earnings ratio of 8.74, what they expect is a total return of 8.74%. So we can proxy that 8.74. We could say, all right, if that's reasonable, we could say 8.74 equals 1.8 plus expected growth rate. And then we could say, all right, then the market is saying that the expected growth rate is 8.74 minus 1.8, or about 6.94, which is pretty aggressive for a large cap stock like HCA. But regardless, you would want to know, you would want some estimate of the growth rate. You could be given the dividend. You'd get you would have the dividend from something like Yahoo Finance. You could go on and see what the next expected dividend is. And then you would just get the P0 is the current price, and you could calculate what you think the required rate of return is. So that's the second option that we've worked through in prior chapters. So we had CAPM, and then we had the constant growth dividend valuation model. So that is that. And now the third one. So those are pretty mechanical models, right? The third one is much more what I would call artistic. So the third one is the debt cost plus premium approach. And basically what that says is the required rate of return on equity is going to be a function of the required rate of return on the debt plus some risk premium. Right. So it's relatively easy to observe the required rate of return on their debt. You can just look at market prices. So you could, you can go and find the prices of HCA's debt and what their current yield to maturity is, and you can estimate what the required rate of return on HCA debt is. And then that's pretty straightforward. Let's say that's just for sake of argument, let's say that's 5%. I'm sure it isn't, but I'm just making it up. And then you could say, now the art comes in. You say, all right, well, what about that risk premium? Well, the problem with the risk premium is, that's the art, right? How much of a risk premium you should add on is a judgment that an investor will make. So the nice thing about the debt is it incorporates, it incorporates things like inflation. It incorporates, right? These are things we already talked about. It's like, what risks are involved in holding debt? Well, inflation, right? Default. So that's a good measure of kind of inflation, as I talk with a number of you about, is something that applies across the whole market, whereas default is specific to the individual company, you know, how liquidity premiums, maybe in terms of, how easy is it for you to find a buyer for this stock if you did want to sell it? So those are the things that you would incorporate into calculating the risk premium. And I will tell you that kind of as a rule of thumb, it's somewhere between 3 and 5%. Okay, so typically if you're doing this kind of estimate, you're going to start with whatever the yield to maturity is for the equity associated, sorry, the yield to maturity of the debt associated with whatever company this is that you're trying to figure out. So you get that as a given because that's just the contract. You can observe that. And then you're going to build a risk premium around that. So if you're an investor and you're trying to evaluate what the appropriate required rate of return on equity is, you might use all three methods. And that idea is called triangulation. So some of you may have done like triangulation kind of problems in, geometry or something like that, where you have a couple of different points and you're told, all right, from this point and this point, we're trying to find, the kind of the average or where does it tell us, it is. So if the CAPM tells you, the debt should be, or the RE should be 9%, and the constant growth model tells you it should be 8.5%, and the debt plus tells you it should be 10%. One thing would be to just average those three together. So you'd get, 17.5 divided by 3. And you'd say, that's wrong. What did I do? 27.5 divided by 3, 9.17, right? That's that's an approach. You're being fairly agnostic about which approach is better. But investors will look at all three of these to justify a required rate of return. Okay. So now we've talked about, let's see. We've talked about, in our estimate, looking at our discussion of weighted average cost of capital or corporate cost of capital. We've now talked about how to get at the required rate of return on the debt, the required rate of return on the equity. Some points now about not-for-profits, right? So not-for-profits, so not-for-profits don't trade on, don't have stock prices, so you can't do they don't pay dividends, so you can't do the dividend model. You could do CAPM, right? So you could find, you could say, well, I'm going to use the treasury bond. That applies no matter what. And you could find a proxy. You could use, the broad stock market index. That's all fine. That's all stuff you could get out. But how do you calculate, the beta? Well, it's a little harder you calculate the beta of a for-profit by looking at how the stock price of the for-profit fluctuates with the market. But with a not-for-profit, you're not going to have a stock market to compare. Well, I'm pointing at something you can't see. I really don't like this whole thing. Sorry. So I was saying, you have your CAPM, this portion of the CAPM is observable, right? We just go get the 10-year treasury. That's going to apply to a not-for-profit regardless. The stock market index doesn't have anything to do with not-for-profit. It's the calculation of the beta that gets more, gets tricky with a not-for-profit, because they don't have a stock price to compare to how it's doing in the market. Because remember, the beta is a measure of how the stock price of the company that you're looking at tracks with respect to the broad stock market index that you're using as a matter of comparison. So that gets a little tricky. But, kind of the bottom line is you still have to respect the idea that there is an opportunity cost, right? Even for a not-for-profit. So if in this case, instead of investors, but the community gives money to this entity, this not-for-profit entity, say Wentworth Douglas, gives money to Wentworth Douglas, it can't give that same money to a different charity or charitable cause. So the opportunity cost of giving money to Wentworth Douglas is you can't give it to, I'm trying to think, the Stratford Health Alliance or something like that, or the Red Cross, or the YMCA, the Dover YMCA. I don't think there is a Dover YMCA, but if there was a Dover YMCA, if you give the money to Wentworth Douglas, you can't give it to the YMCA. So the opportunity cost is the foregone benefits that you leave on the table when you give it to somebody else. So if I give the money to Wentworth Douglas, I don't get to give it to the YMCA. And so the, YMCAs, I don't know if you've used YMCAs in your history, but, they do a lot of programming for kids. They often have like summer camps, and, they'll do daycare and things like that. Those are all valuable things for a community, and they usually provide them at a low cost. So you're making a choice. The trade-off is, do you want healthcare or do you want cheap childcare? And so the opportunity cost is, if you give the money to the healthcare organization, the opportunity cost is you're taking it away from the entity that would provide childcare or early, interventions for, young teenagers or something like that. So there is a real cost. So we can't say that the required rate of return on equity for a not-for-profit is equal to zero. That's just doesn't make any sense, right? So when we look at Wentworth Douglas's cost of capital, right, we can measure we don't have to worry about their tax, the post-tax rate, but they do have, we can measure their required rate of return on debt. That's whatever they pay on their debt. And then we've got this vague, required rate of return on equity. They don't really have equity though, right? They have this, this fund capital that, isn't really owned by anybody. It's owned vaguely by the community. So some people would say, well, it's just zero. And I would argue that's a bad perspective, but that is one option. So option one would be required rate of return on equity for not-for-profit is just zero. But that's not a good measure. That doesn't respect the fact that there really is an opportunity cost. So that's not likely. Another option would be, well, fund capital should be measured with respect to short-term investments. Things like CDs or T-bills. So is the next best. So one way to ask yourself, would that be the appropriate uh, uh, rate to proxy for the required rate of return on equity? Well, that would kind of ask yourself, what would be the next best use for this money? Um, and typically when you make a donation, you're making a donation, particularly a large donation to an organization like Wentworth Douglas. So if you're a wealthy person, usually you're making, when you go to make like $1 million donation to an organization, you're thinking this is going to be used towards capital, right? You're going to build a new building and you're going to put my name on it preferably, or you're going to buy a new, MRI machine or something like that. So short term, my argument would be short term investments as a proxy probably isn't a good measure. A third kind of approach would be to say, well, fund capital, right? So fund capital is the required, is the, equity in a not-for-profit. That's broad, another phrase for broadly for um, for the equity stake in the not-for-profit. So it should be equal to its required rate of return on equity should be equal to its growth rate. So in this case, you would look at and evaluate how fast is the demand for a hospital's services growing, and so therefore equity's got to grow at least that fast. So if the demand for the services, so let's say the population is growing at 8%, then you would want a required rate of return on equity equal to the growth, the expected growth of 8%. That's an okay idea. That's a better idea. At least that's anchored to something to do with the organization. Um, uh, uh, another approach is, so I've had conversations with folks like at Exeter in particular. You guys know I do a lot of work with Exeter, and they've had some conversations um, to say, they've been evaluated. They are going to be looking to build a new tower. So they're gonna basically build a large add-on to their building and move all their inpatient services to this new building. And rating agencies, so required rate of return on equity, could be set by a rating agency. So you just got some sort of expert opinion out there, and they would say, the RRE should be equal to some expected ROE, right? So they should be earning some ROE. That's fine in order to maintain, so in order to maintain a particular rating. So if you're going to be an A rated not-for-profit, maybe you need to earn, say 7% ROE. If you're going to be a BBB, maybe you need to earn 6% ROE. So you could just take those from the rating companies. And kind of the last option is to say the RRE for your not-for-profit should be equal to some RRE for a for-profit. I'm going to shorthand 4 with the number 4, right? So with the idea that, if the not-for-profit wasn't doing the services, then a for-profit could step in and do the services. And so it kind of becomes a question of make versus buy, right? So we used to talk about this a lot, this idea of make versus buy in the military. In the military health system, we would often ask ourselves, should we build the capacity inside of our military, healthcare? Maybe you have a clinic like Portsmouth Regional, sorry, not Portsmouth Regional, Portsmouth Naval Shipyard, which is technically in Kittery, even though it's named Portsmouth, which is just up the street from us, is actually where I go get my health care. And they send out, they basically have, they have x-ray, they have lab and pharmacy, and they have a family practice, and they have optometry. But if you need anything other than family practice and optometry in terms of medical services, you get sent out to the economy, meaning you get referred out to a non-military doctor. So the question all the time for that little clinic probably is, should we try to build another practice? Do we have enough volume to say justify having a orthopedic practice here or physical therapy here, or should we continue to send our beneficiaries out to the market? So you could look at the required rate of return on a similar for-profit entity and say, okay, if you can't, that should be the rate that we should use to evaluate our um, rate of return. All right. So all those are in the text. You can read about that, in more detail. What I want to do now is switch gears a little bit and look more closely at the weighted average cost of capital and how different balances of the weighted average cost of capital um, affect, different balances in the financial structure affect the actual weighted average cost of capital that we wind up paying. So here we had, right, going back to our original example, we had a all equity financed capital structure, a 50-50 capital structure, and a 20-80 capital structure, right? So we had 80% debt, 20% equity. Here we had a 50% equity, 50% debt, and here we had 100% equity, 0% debt. So why would we want, why is it more appealing to maybe have some debt or maybe have a lot of debt than it is to have 100% equity? Well, we talked about the impact of risk, right? One of the problems with having a lot of debt is the risk of when things go bad, we still have to pay our interest regardless of how well our operations are doing. So there's risk involved in having debt, right? It's likewise here we had 50, this was the results from the 50-50. So you remember that. And then let's see. So on the one hand, having a lot of debt creates some financial risk, but it also creates the opportunity for amplifying your gains dramatically, right? So we said, with 80% debt, our expected ROE was almost 60%, and we had the possibility of even making almost 150%. So that's crazy great, right? As opposed to making 17.5%. The flip side, of course, was, again, you could lose a lot of money in the process. So that's one benefit, right? Is there's one benefit of a lot of equity is that you have a lot more security, but with more debt, you can potentially magnify your returns. What we want to look at right now is what is the impact of different capital structures on our weighted average cost of capital. Let me switch. So what I've done here, and you've got access to this example. because it is loaded on Canvas. So here in this example, we start with 10% debt, which would imply that we have 90% equity, and we go 10% debt, 90% equity, up to 90% debt and 10% equity. This firm at 10% equity, 10% debt, its required rate of return on equity is 15%. And at 10% debt, it can borrow at 7%. And this is the not-for-profit version, right? So they're already getting a little bit of the benefit of getting their investors can buy at a reduced tax or a tax reduced rate. So investors like theirs because they don't pay taxes. Okay, so and probably we could even imagine at 100% equity, they'd probably pay 15% required rate of return on equity. And so if we had, I'll just add that line since I can. Let's say 0%. Let's say it is 15% equity, still 7% would be the offered. They aren't paying it, but the offered. And so the weighted average cost of capital would be I'd have to do this calculation. 1 minus the percent of debt times the required rate of return on equity plus the percent of the debt times the required rate of return on the debt. And so we get 15 because if my weighted average cost of capital, in this case, it's a not-for-profit, so it's just going to be the weight of the debt times the required rate of return on the debt plus the weight of the equity times the required rate of return on the equity. All right, I'm making a huge mess. Sorry, I'm gonna try that again. I'm gonna flip my page. Just get a fresh page. I have to say, it's really weird sitting in my room here, knowing that you all are out there, but I can't hear or see you at all. It's a little unnerving. Weight of debt times required rate of return on debt plus weight of equity times required rate of return on equity, right? And we aren't using the 1 plus T or 1 minus T here because this is a not-for-profit entity. So when I have 0% debt and a 7% required rate of return on equity, and then here I have 100%, right, or 1, right, weight times 15%, then what I'm going to wind up with is 0 plus 15 or 15, right? Now, why does that matter? So I have a question to you. Why do I care about having, what do I do? Let's just refresh. What do I do with that weighted average cost of capital? What do I use it for? We've referred to it as what in the past? Got a couple of different words for it. The hurdle rate. Good. Thank you, Peter. Right. Hurdle rate is another word we've used, is the coupon. No, not the coupon rate. Discount rate. Good. All right. Hurdle rate, discount rate, interest rate that we're applying to an investment. right? Those are, that's what we're trying to calculate here. So if we have a 15% discount rate or hurdle rate, that's a pretty big number, right? Your investment's got to do really, really well in order to get over that 15% hurdle. So let's flip back to our discussion here. So at 0%, the weighted average cost of capital is 15, right? At 10%, the weighted average cost of capital starts to go down a little bit. Why is that? Well, our weighted average cost of capital is now made up of 90% of 15% and 10% of 70%, right? So this formula is going to be 90% of 15 plus 10% of 7. So if I flip back here, right, my weighted average cost of capital becomes, I said, 10% debt at 7 plus 90% equity at 15. So I get 0.7 plus 0.9 times 15 is 13.5, which is going to add up to 14.2%. So by going from 100% equity to 90% equity, my hurdle rate drops from 15 to 14.2. Now, I'm not going to keep going back here, but let you get the idea. So as I start to increase my debt, right, to 20% now, my weighted average cost of capital goes to 13.4. Then at 30%, it goes to 12.6. So by increasing my my capital structure, or changing my capital structure from 100% debt to 30% debt, 100% equity to 30% debt and 70% equity, I reduce my hurdle rate from 15 to 12.6. So if I can cut my hurdle rate from 15 to 12.6, you guys who said, okay, discount rate, hurdle rate, you identified that. What does that mean for me as a manager thinking about projects? Can I do more projects now or fewer projects when I drop to, when I cut my hurdle rate from 15 to 12.6? Exactly. Good. So you guys are saying you can do more, and that's correct, right? Because the hurdle rate, right, or the weighted average cost of capital tells me what return on investment I have to get from doing a project. So when my weighted average cost of capital is 15%, I have to earn at least 15% return each time I do an investment. So that's a really high, standard to judge. But if I can cut my hurdle rate to say 12.6, I can do more. I can do more investments. I'm going to be able to find more investments that yield, say, 13% than I am that yield 16%. Okay, so I've gone to 30% debt, 70% equity. Then I go to 40% debt and 60% equity. And what happens is my required rate of return on debt starts to go up. Now, why would that be? Why would my required rate of return on debt start to increase as I increase the percent of debt that I hold in my company? So the more risk, good. Yeah, having more risk, more debt is riskier. Exactly. It's riskier, right? Because we were looking at in the previous, we were looking over here, right? The 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 variations that had more debt had higher standard deviations. It's more risky, right? For the investor who holds the debt, who expects to be paid back, the investor that expects to be paid back, that's lending money to this firm, the more debt this firm has, the more likely it is that you're going to wind up with a negative return, and it's going to be hard for that company to pay you back. So as they increase the amount of debt that they have, right, the investors are going to be like, you're riskier now. Your default risk is going up. Remember, that's one of the big components to deciding what interest rate a company is going to have to pay. So as I increase my debt ratio, my default risk goes up, and as my default risk goes up, the required rate of return on debt, right, the interest rate that investors are going to require when they lend me money is going to increase as well. So as I go from 40 to 50, from 30 to 40, I now have to pay 50, 7.5 instead of 7. When I go to 50, it's now 8, right? And I go to 60, it's now 9.5, because investors are starting to get more and more worried about the fact that you might default, right? Because if you have a bad year, you won't be able to pay me back. And if you continue on that kind of logical track, as you approach 90% debt, well, as you approach 80% debt, the required rate of return on debt is now equal to the original required rate of return on equity. It's 15%, and it goes even higher as you approach 90%. The idea here being, these numbers these are just numbers I made up, but they reflect the reality that actually operates in the market. And that is, if you're a debt holder, right, if you hold debt of a firm and you hold 90%, if the firm is 90% debt financed, basically you are an owner of the firm, right? I mean, you own 90% of it. You pretty much own the whole darn company. And so the required rate of return that you're going to have now you're not really thinking anymore like a debt holder. You're really kind of like more like an equity holder, right? And so you expect to have equity-like returns. And so if we go down, if we go to the graph, that you guys have probably been looking at, the orange line is the graph of the required rate of return on debt. And so you can see as we progress along, the bottom should be the percent debt. Let me see if I can change that. There we go. And so as we progress from 0 to 10, onwards up to 80 or 90%, I think that's not quite right. Let me fix that again. There we go. As we go from 10 up to 90, you can see that it's tracking. Yeah, you know what? Let's add this whole thing. We get there now. Good. So starts out at 7. This is what they would require, as we start to increase, and as we go kind of past, there's a turning point after which the investors expect ever more return on their debt. Now let's look at the equity file, equity column. We start at 15, and as we increase the amount of debt, right, the return on equity goes up. Again, why? Because default, right? It's like the more debt the company holds, the more risk there is that the equity holders won't ever get, will wind up losing all their investment. And so even the equity holders require a higher rate of return as the firm becomes more leveraged. So what you see is, the debt goes steadily up. The equity goes up at a slower rate. But if you combine both the debt and the equity, and so the gray line matches up with the weighted average cost of capital, what you kind of see is initially, as we add debt, our cost of capital goes down, right? If you can see here, the combined, in the combined column, as we add debt, the weighted average cost of capital falls until we get to about 50%, right? And then the weighted average cost of capital starts to go up as both the required rate of return on the debt and the required rate of return on the equity both go up. So one of the things that managers look to do is get to an optimal capital structure. Okay, optimal capital structure, and so. And that's the phrase that we use to refer to the point where the required rate of return, the weighted average cost of capital reaches its lowest point. And so its lowest point is going to be at about 50-50. And so this is where investors have evaluated that the best mix of capital for this company is about 50-50, after which the combined investors are going to require a rising amount of return. So that's kind of their optimal capital structure. Let's see. There's a concept. So two ideas here. So I use the phrase optimal capital structure. Right, refers to the lowest weighted average cost of capital that you can generate, right? So the optimal capital structure is kind of where we're getting that great, really low return. Debt capacity is another idea. Debt capacity refers to the amount of debt that a firm can manage without an excessive increase in financial risk. So going back here, right? So somewhere around 50%, maybe 60%, the firm can handle that. But as we start to go into the 70, 80%, they're exceeding their debt capacity, right? And so investors start to punish them for having too much debt. One more idea. We've got a couple of minutes, so one last idea. I want to switch back, and this is operational risk versus financial risk. Okay, so operational risk and financial risk. Our firm's total risk is measured by its standard deviation. So we're looking at the three different arrangements of capital structure that we've talked about. We had the first one is 100% equity. The second one was 50-50 equity. So we'll just focus on those for the moment. With 0% debt or 100% equity, this firm has a 12.37 standard deviation. So its expected returns are 12.37. All of that risk comes from operations, okay? Because they have no financial risk. All of their risk comes from the operations because their financing doesn't have any impact on it. Over here, in this in the 50-50 arrangement, they have increased risk not because of operations, right? Because the operational income is the same between the two firms, but because they're taking on debt. So their standard deviation is bigger here because of the way they're financed as opposed to over here. So the operational risk could be measured at 12.37. The total risk and that would also be the total risk. So the operational risk is equal to the total risk when you have a firm with 100% equity financing. Here, the operational risk, the total risk is equal to the sum of the operational risk and the financial risk. Well, the operational risk for this firm is 12.37. So the financial risk is equal to the total risk minus the operational risk, or also 12.37. It just happens to work out that way because of the numbers that we're working with. So the key thing to remember is, and we'll stop on this, is total risk is equal to operational risk plus financial risk. So financial risk is equal to total risk minus op risk, right? And so operational risk is the risk or the standard deviation of the return on equity if you have 100% equity. All right, I'm 1 minute over, so sorry about that. So
Can you have the link for the econ Zoom?
Yeah, you know what I will do is you should have gotten it, but I will send it out again as soon as we hang up here, okay? All right, so for Monday, you should submit your Chapter 13 homework. We've pretty much covered everything. The only thing I skipped was calculating the cost of capital for a small business. You can read through that. It's not a whole lot more complicated, and I'm actually really not that concerned about it. There may be a problem or two about it, but I probably won't bother with that on the test. All right. I will hang out for a minute on Zoom. If you guys have questions, you can ask me. I will send the econ link here in just a moment. All right, that's it for today for finance. I will see you back here at 3:40 for econ. All right. So class done. If you've got a question, feel free to shoot me. I'll stay here for another five minutes until you're all gone. My Montreal coffee mug. Trapped at home. Can't travel. All right. Let me send out the link for the econ class.